We have an explosion of excessive risk everywhere, including junk bonds trading near their most expensive prices ever, the highest levels of corporate debt ever, the most expensive stock market ever by several measures, the highest margin debt on record, real estate bubbles across the globe, and pensions that are about to go bust. So, was the recent sell off in the market the start of the end? Let's take a look. Before we really talk about the stock market and whether this correction is the beginning of the end or otherwise, we need to understand, in my humble opinion, the problem. The stock market is the symptom, but the cause, the disease, right now, in my humble opinion, is the 10-year Treasury. And right now, we are above 3%, and we breached that 3.2% that you can see over here in the far upper right. Now, in my humble opinion, we're going to continue higher in that yield rate, and that is shown here in the MAC. We had a bottom here after several months of consolidation, but the bottom here in the fast line, and it came up through the slow line, and it looks like it is accelerating. So, moving here into the MACD, we see that as well. Into the RSI, we have a turn down, but I think we're going to probably bounce back and head back on up at some point in time. Not sure exactly when. But the stochastic is the one thing I'm looking at, is that we've bottomed here and we've gone up to this 80 line near the what's called the overbought. And of course, there's not necessarily an overbought here. But as you can see in the past, that the territory above that overbought level with regard to the stochastic stayed up above that level for several months. Now we're just approaching that level, and I think that we're going to spend some time up there, which means that the yield is going to remain somewhere around 3%, if not higher. Moving on down here into the Williams, we did our first move above the -20 line back in early September, and we've done some sawtoothing, and I think that's going to continue as it did during this time frame there. So moving on back up here, Dr. Voodoo says this is the cause of the problems in the stock market. We've got these rates going on up, and with the levels of the corporate debt, the personal debt, and the government debt, all at records, including margin debt, the rates above 3.2 and higher is going to cause some pain, and that pain is going to be reflected in the stock market. So in my humble opinion, again, I think that rates are going to stay up here for a while, which means that the stock market, the symptom, is going to also remain for a while. But let's go take a closer look at the stock market. This chart is the 6-month daily on the SPY, and then I did an overlay of the 10-year Treasury, TNX. And the 10-year Treasury is in the black. And we can see here that in the May to the June timeframe, we hit a peak there. But that is roughly consistent with the peak here in, say, late September. So during this time frame, the interest rates stayed in this sort of channel here, while the market got used to those rates and trended on upward. It wasn't until this point here where interest rates took a pretty steep spike up to that level there that the stock market decided that was a bit too high and had a little bit of a tantrum and sold off. So in my opinion, you need to understand what's going on with the 10-year rates. And as I indicated before, I think rates are going to stay in this upper area here for a while. And so in my opinion, it's going to take the market some time to internalize those higher rates, get used to it before we can set a bottom foundation and then move up off of that in the stock market. So now let's go to another chart for another perspective. This chart here is the 3-year daily chart on the spiders. And again, just for frame of reference, it goes all the way back to late 2015 and then the bottom that we had in early 2016. And I've just drawn a simple line, trend line from the bottom here through these other bottoms that we've had all the way on up here to the current sell-off. So in a very simplistic manner, in my opinion, right now, this sell-off just seems to be kind of a garden variety correction that we've seen several times going back to 2016. But now let's go take a look at another chart. This is the 2-year daily chart on the volatility index, or the VIX. We've talked about this before, so I'm not going to go into detail on an explanation. But the current level, we hit a peak at this point here earlier this week. Now, for reference, in the March to April timeframe, we hit a peak there. And then, of course, in early February, when we had that big correction, we hit a peak at that point there. And if you go back, you can see we have just a small little eruptions at various times going all the way back here, in here, and then, of course, in here. Now, again, the current level is slightly higher than we had in the March to April timeframe, but still well below the correction in early February of this year. Moving on down, the MACD, we're still accelerating on the upside. So we'll have to wait and see what happens next week. But in my opinion, I think we're going to start topping out there. Looking here at the histogram, you can see that, again, we're not quite at the level we were in the correction in early February. Here in the relative strength, we got to this point there, which was consistent to these levels back here, more or less. So in my opinion, we're starting to hit these highs here, and I think the VIX is going to lose some momentum, but we'll see coming into this week. The stochastic here also shows that we didn't quite make it up to that 80 level as we did here, and we actually did here at that point, and of course here. So in my opinion, this is just another garden variety correction. It is not the beginning of any downtrend or stock market crash. Just, I think, a correction that we need to have now and then so we can set up another footing for the market to use as a stepping stone on its way up. That's what it looks like today, but we'll certainly see into next week. But for now, I don't think it's time to panic. I think it's time to relax and perhaps take advantage of some opportunities in the market. So for today, that's ChewDog Charts. Thank you.